All of us play or watch games. What is the role of a scorekeeper in a game like a cricket or hockey? The scorekeeper records the scores of the team players. That includes the penalty and awards. At the end of the game, the scorekeeper summarizes the team performance and announces the results. Accountants are the scorekeeper for business organizations. Accountant records large volume of data and generate reports out of that one. There are several other uses of financial reports. For example, if you are investing money in a company or depositing your saving in a bank, you want to know the financial condition of the company or banks before giving your money. Like that, there are several other external uses. For example, investors and lenders, tax authorities, suppliers of goods and services would like to know the financial condition of the company. In some cases, the customers are also likely users of the financial statements. Managers are the largest consumer of financial information generated by the accounting system. In this course, we are going to see how managers use accounting information. Managers use accounting information for planning, decision making and controlling. These are the three important activities of the managers. For example, if you are bidding for a project or submitting a tender, you need a cost data about the project produced by the accounting system. Similarly, at the end of the year, if your human resources accounting department would like to need the data to work out the incentives for the employees of different divisions, organizations generally follow two types of accounting system called financial accounting and cost accounting system. The financial accounting system records all financial transactions that take place between a company and an outsider. Outsiders here include suppliers, employees, lenders, investors and customers. The financial accountant at the end of the period, like our scorekeeper, summarizes all these transactions to produce income statement, balance sheet and cash flow statement. These are the three important financial statements of a company. In a small and simple organization, the job of a financial accountant in preparing these financial statements is fairly simple. He can work independently and produce financial statement. For a large and complex organization, it is not easy. Information available with a financial accountant is not adequate to prepare the financial statement. Here is a small example to illustrate this point. We have a small company called Alpha Company and it produces a few engineering components used by automobile companies. The manufacturing process used by Alpha Company is simple. It takes few minutes to complete a product. The company produces a product based on the orders received from the customers. Financial accountant has all the details related to the purchase of material, wages paid to workers and other expenses. The accountant also has a sales detail. Income statement can be easily prepared with this set of information. For example, if the total sales is 10,000 units in a month and the selling price is 80 per unit, the total sales is 800,000. Material cost is 500,000. Salary, power, rent and other expenses are 200,000. With this information, the income statement will show a profit of 1 lakh. Let us assume the Alpha Company over the years increased the volume, added more products, added more customers and start producing a very complex products. The number of material that the company uses also increased. Few of them are also imported. Due to uncertainty in the supply, the company stores 10-day worth of a material requirement. The company is no more made to order company. The company produces a few standard products and stores it before selling it to customer. The financial accountant of Alpha Company now faces serious challenge. They have all the information related to sales, material purchased and other expenses incurred. However, the accountant is not in a position to compute the profit using the same format that he was using earlier when the company was a small company. The reason is not all material procured are consumed. For example, the purchase department might have procured 100 tons of a material, but only 72 tons are consumed by the production department. Not all items produced are also sold. The production might have started the production for 3,400 units, but completed only 3,000 units, leaving 400 units in the process. And it could have also sold only 2,600 units. The accountant cannot compare sales of the 2,600 units with 100 tons of material and expenses related to 3,400. If he does, he will show a huge loss for the period. The accountant now needs costs associated with the 2,600 units. This is called cost of sales. An easy way to compute the cost of sales is deducting the value of a material lying in the stores value of a semi-finished product work in process in the production shop floor, and value of an unsold unit lying in the warehouses. To get these values, the financial accountant hires a cost accountant. Cost accountant tracks all these goods and services moving within the company. If the stores issues a material to the production shop, cost accountant records this transaction. Financial accountants are not bothered. If production shop completes and transfers a unit to a warehouse, cost accountant again captures this movement. At any point of a time, cost accountant knows the value of a material lying in the stores, the value of a semi-finished product lying in the process, value of a finished goods lying in the warehouses. At the end of the period, he supplies the value of a closing stock or a closing inventory value to the financial accountant. The job of the financial accountant is now easy. Profit is now equal to sales less total expenses less value of a closing stock. With the help of the cost accountant, the financial accountant completes the income statement. This is the story of the birth of a cost accounting. A few decades back, financial accountant established a sub-accounting system called cost accounting system to get the value of the closing stock. Cost accounting produces a large amount of data, particularly in a multi-product company. Today, they are not only used for inventory valuation, but also managerial decision. Accounting system is gearing up in collecting and compiling the financial data of competitors, customers and suppliers, which are also used by the managers. The Indian office of a multinational company today supply information about the potential customers to the sales team located at different parts of the world. Accounting information is often used to identify the potential customer. Let us take an example of a software company which specializes in supply chain software. It would like to know the companies where the inventory values are very high compared to some benchmark values. Once they identify the companies, the sales team will pitch for selling the software, justifying that it will help them to manage the inventory better and reduce the overall inventory.